So in this particular case, what has changed for him is that his first wife, of course, is history. The paralegal is gone, and that office romance fizzled out. So Jack finally finds the love of his life around the corner and bumps into her, literally. And they decide it's love at first sight. It's, of course, happening all so fast, but he's now married to Sweet Sally. And she's the receptionist for a local mortgage company, makes very good income. He stops by to share his exciting news, and he's even more motivated now to get his taxes squared away. He was a little distracted the past couple months, but he is ready to get this taken care of. He's ready to sign the dotted line. You congratulate him and tell him that you need to make some changes, and you set to work preparing another offer calculation to see what these new changes and what this life change has done to his RCP, that reasonable collection potential number, his bottom line, basically. So what's happened now is the new wife is going to be another actual member in the household. So instead of 3, we're going to bump that up on the standards to 4 in the household. So she also contributes to household expenses. So we again have to be careful of that proration. She is not liable at all for the tax debt. So only the things that he owns or has a partial interest in do we have to count on the assets. But on the expenses, we do have to prorate whatever she's contributing towards. Now, she already owns a home. And here's the catch. Jack tells you that because she's so in love with him and decided that the moment they get married, she added him to the deed as a 50% owner of their home. So just like that, now you have to worry about 50% of the equity in a home that you didn't have to before. Now, the mortgage on this home is a little bit on the expensive side, and that's going to be problematic because even though the expense is there, it's going to be considered excessive. It's going to be considered extravagant, and you're only going to be able to use up to the standard. So even though they're looking to refinance soon, things as they are right now, we just have to use up to the standard. And we're going to see how do these changes affect Jack's offer and how Jack's decisions have now affected what we were working with him on in the way of putting this offer together for him. So we're going to take a look and see what this has done. As we look at Jack, we get to see, his dependents have changed. His home is going to be the big change that we have to consider. So if we go in here now and we have to look at a home, we're going to say he now has a personal residence, and it's only that he have to consider 50%, but it's worth $200,000. And the mortgage on it is only $120,000. So you can see right away the equity of the $80,000, he gets half of that. We get to bump up his equity by $40,000 because of the decision that they've made. Now you can't, of course, by any stretch of the imagination, for ethical purposes, you can't recommend that he gets divorced. You can't recommend that she takes, him off of the name of or the deed of the property, because that's a decision that he made. We have to work with it. And that's sometimes a question I get from accountants is, well, can you just tell him to go get divorced? And no, you can't. That's unfortunate that the timing of the events in his life has made his offer worse and worse, but this is what we have to deal with in this case. The other things is we look at he has a checking account with a spouse that she added him as a 50% owner. So here we're lucky that the $2,500 checking account we don't have to use because he's using it for his monthly living expenses. So we get to have a little bit of a slide there. As far as the investments, there aren't any effect in his investments. It really is the biggest effect is that house. The other thing is she is contributing. She earns more. So you can imagine that prorated percentage is going to go down. She earns more than him. So, and she's contributing towards a lot of these household expenses. So in the same case, we're just going to jump over and see what that looks like, already having done that work, and what that has done to his 433A. So we're going to jump over there right now and look at his expenses. And we're going to take a look at the prorated amounts. And we have to use his income divided with her income, and that's how we get our percentage. So we're just going to skip down real fast to that section of it. And you can already see some of our numbers are changing a bit. The most noticeable one is that we have some equity in there we did not have before. You may say, well, wait a second, I could remember that it was going to be like $40,000. But don't forget, we luckily get to do something that is 50% of that $200,000, 50% of our quick sale value, we only have to take 80% of it and then 50% of the loan, that mortgage left on it. So it's still going to bump it up, but not nearly as bad as it may have seemed on the surface because you still get to do the quick sale value. So $20,000 more in equity we have to add. So this number is definitely changing from what we had before, but we want to really concentrate again on the expenses and how that works for proration, because even though she's not liable, she's contributing. So we say, first of all, wait, we get more of our standards because now there's 4 people in the household, and that's exactly right. We do get to bump up our standards, but as we scooch down here right now, as we look at these living expenses, we say, here's his income, $5,400. Her income per month, so she earns a little bit more, has more income, so our percentage, 46.43%. We don't get to take much of that nice higher amount of the standards. It's just going to be a pretty small $766. So if that is something that, isn't going to help us all that much, as she's putting towards food, clothing, and miscellaneous, she's putting towards the household expenses, that all means that we have to lower those based on the percentage, 46.43%. So even though she would have a whole lot more and they would have more in the housing, if you look at their actual expenses, $3,000 a month in actual expenses, and we get a measly $866 a month. And that's just because of the way we have to count that for her income compared with his income, and even the little bump you get in the standards is not all that exciting. So that's what we're looking at as we go ahead and look at more of a summary of this. I'm going to jump up again here to our tax form, and we're going to see what the total looked like. So remember, first of all, our assets were greater. We have over $20,000 of assets added. So our asset section again was $21,200 of assets. And then our income, because we don't count her income again, she's not liable, we count his income. But if you take a look at those expenses, they're really not all that exciting. We still end up with leftover. The reality is he would have none left over if you were able to use all those expenses. But we take the $951 times 12. That's $11,000 towards our offer and compromise. But when we add in the $20,000 of assets, our offer now has jumped to $32,000. And it's just because she deeded half of the house over to him. So that's a whole different situation. We take a look at that and compare to our offer and compromise form, and we're going to see, what does this look like now? What kind of a monthly payment would we have now? And I did want to stop, just for a second and also explain some of the other items on the offer form. As we look at, we've got to tell them, which tax periods we're including. We want to tell them, if he happens to be low income certification. So we would be able to say family of 4, but does he really have less than $5,125 total coming in? No, not altogether, because he's a little bit over that and has $5,400 a month. So doesn't get that low income certification, even though his family size bumped up 1. He's close, but not close enough for these purposes. And then we get to tell them very specific things, like if it's for business, what type of an offer. So we're going to say doubtless collectability. We really don't have a ETA or exceptional circumstance type of offer. You can, if you think it's both, you can certainly, there's special circumstances, mark both of them and attach the reasons. But normally you don't have to attach reasons. It's all based on a math calculation. So for the most part, they really don't care too much for the reasons. You don't have to fill out that reason section. You do have to say what you're going to offer. Is it a lump sum? Or is it that periodic payment where we spread it out over a couple years? You can have it paid either 6 months or 24 months, but this is from the moment you submit the offer. So you may have him on the hook for paying monthly payments for 2 full years from the moment you submit the offer. Where the lump sum is after, your first initial 20% down. The rest of this is after it's accepted. So 2 different ways that you can do the offer, certainly. But our amount has now jumped up to $32,000. So that means our initial down payment, instead of our lowest point, was when we had about a $1,300 down payment, and we were sitting about $1,000 a month, maybe with the last one at $1,500, is now jumped to a $6,500, $6,522 down payment, with the remainder of this being a $5,218 payment every month even. I just went ahead and evened it out every month after the offer is accepted. So in light of $100,000, you know, a $32,000 offer is still not bad. I mean, we don't, you know, maybe don't like it that it's jumped up so much, but the $32,000 offer would require $5,000 a month payment. So this is starting to get to where you'd want to make sure that you don't set your taxpayer up to fail. So in this particular case, you'd want to make sure that your taxpayer is able to come up with these amounts and that he's making that every single month on the dot after that offer is accepted. Because the moment he fails in making one of these payments as well, they go ahead and apply the tax, but that offer is no longer a valid offer. So that's something you want to make sure that you consider as you put this together, that your taxpayer is going to be able to meet those payments. So we've really considered what happens now with the new wife and how that has changed the situation. And they're certainly a little upset because Jack remembers what it was that your lowest amount is when you came up with that offer, but that was before all of his change in circumstances. So they want to think about it for a little while again. So Jack and his new wife, they basically 2 weeks later come in for an update after you've had a chance to kind of go through and re-look at all these numbers. And they tell you, hey, I don't know if this makes any difference in anything, but we just now found out that there is a leak that they discovered behind the bathroom shower wall. And the unfortunate thing is that when the bathroom was remodeled years ago, it was not discovered that there was a slow leak, and the insurance company indicated they're not going to cover it because it was a slow leak over time. To further complicate matters, the entire bathroom was remodeled in tile. We're talking floors, ceiling, wall, I mean the whole entire thing, unbelievably done entirely in tile. So they're kind of a little upset because of finding this out, and they don't think they can afford to pay it. And they're concerned about their tax debt still. So they come in, for an update, and they're trying to mull over what they're going to do about this leak they just found in their bathroom. So one of the first things that you recommend is they go ahead and get a estimate from a contractor. You're going to want something in writing to show what this big issue is, because if it's going to change, the idea there is it's no longer going to have the same fair market value as it would if it didn't have this issue. So I'm just going to do a real quick, we're going to recap one more time, just so you can see it on the screen what the amount of the other scenario was, just bringing the wife into his life and what the amounts changed to, basically upwards of about $30,000.